The Australian budget just dropped and the two biggest sacred cows in Australian investing just got touched. We're going to have a look at what has changed, what has not, and how it impacts your portfolio. Welcome to Equity Mates, a show where we explore what's possible in the world of investing. If you've joined us for the first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. I'm laughing at two biggest sacred cows got touched. I'm not sure that's quite the phrase.
Visceral, isn't it?
But, you know, there's certain times of year where finance creators become celebrities.
Yeah.
Budget is like our Christmas, I guess.
Yeah.
A lot of chat around this year's budget. So we're going to break it down. But that's not all we're doing in this episode. We are reviewing the community portfolio. We're doing an investment committee meeting. We're talking about some stocks we might want to sell. And we're getting an alternative asset class pitched in the portfolio. And then we're going to close it out with a 101.
Yes,
almost
101.
a one-on-one on gearing or leverage in the stock market.
How timely.
Which might be particularly relevant given what happened in the budget.
All right, before we get into it, a reminder that tickets to Australia's largest finance festival, FinFest, are going live next week.
Yeah.
So you need to get on the wait list to get early bird access.
FinFest is designed to show that investing isn't boring and that it is for everyone.
Yep.
We're going to have 5 stages with some of the best speakers in Australia, food trucks, bars. It's going to be a lot of fun. And if you're looking at your investments and your portfolio and thinking about how do things change with these budget changes, FinFest is a great place to learn about all the other options outside of property.
So sign up. There'll be a link in the show notes or the description below. Tickets go live next week. Don't miss out.
FinFest is proudly sponsored by Betashares.
All right, let's get into it.
News and markets.
So we're only going to talk about the budget in this news section, Ren. It was dropped on my 35th birthday. We came back from
Happy birthday.
Came back from the restaurant and I turned the TV on, which it didn't go down too well with Harriet. She wasn't too stoked that we were watching the budget, but nonetheless, it was an important one. There was a lot of lead up to it.
Just before we talk about what happened, the actual presentation of the budget itself needs to change.
So boring.
At the minimum, it needs to be TikTok style, split screen, treasurer speaking, Subway Surfer underneath.
Nice. That would be good.
Or like get some graphics on the screen.
Yeah,
maybe.
a few graphics, a few overlays.
And maybe, just maybe, rather than just presenting a shopping list of policies, we actually can present it in a coherent vision and policies in service of a grander vision. But, you know, that's just my 2 cents.
That's a whole other thing.
All right, well, we're going to talk about what we saw in the budget, and then we're really going to talk about our takeaways because, you know, a lot of what actually happened has been well covered ground at this point. But let's talk about the key tax changes and then some other winners and losers.
Well, the major headlines leading into the budget were around capital gains tax and negative gearing. What were they going to do to the Australian property investors to make it more equitable for everyone? And let's start there. As expected, capital gains discount and negative gearing were targeted.
Those are the two sacred cows you're referencing in the opener.
The two sacred cows.
Just to close that circle.
I mean, we were told leading into the election that they wouldn't be touched, but for good reason, I think they have been. But nonetheless, so negative gearing will be limited to new builds. So you will be able to negative gear on new builds. Properties that are currently negative geared will also be exempt. So changes to negative gearing will kick in from
1st of July,
2027.
But you don't have until then to buy a place.
No, it had to have settled prior to 7:30 the night of the budget.
Yes.
Or you had to have signed the contract. Now let's turn to the capital gains tax discount. The 50% capital gains discount is going to be replaced with a cost-based indexation at inflation. Now we'll get into that in a moment, but it also comes with a minimum 30% capital gains tax.
Yes, which I think is something we're going to dwell on a little bit more in a second because that is worth talking about. And I think those changes bring up our first big budget winner of the night, accountants.
Yeah, exactly. And it's already blowing up in the Equity Mates Facebook discussion group how we now measure capital gains on every single dollar cost average that we do.
Yeah.
It's not just a simple, you've held it for over 12 months, so you get a 50% capital gains tax discount. You're going to need to measure the inflation that has occurred over that period, what your new cost base is going to be, and then the amount of capital gains that you're going to have to pay tax on.
We both use ShareSite to track our portfolios, and I imagine their developers are hard at work
scrambling today.
There's been a few Red Bulls and a few late nights, I reckon, as they work out that. But I imagine platforms like ShareSite are going to become more valuable because
Absolutely.
Tracking your capital gains, how much you can actually discount it by inflation, is going to become a lot more complex. So sharesite.com/equitymates if you want to check that out.
Yes.
Well, let's put a pin in tax and we'll come back to it. Some of the other big winners, I think there was a big investment in healthcare.
Yeah.
So $25 billion went to funding public hospitals over the next 5 years and $6 billion to new and amended PBS listings, so Pharmaceutical Benefit Scheme.
Another winner, Ren, is working Australians, salaried working Australians. We've had some form of tax cut announced. They're calling it the Working Australians Tax Offset. It's a $250 offset that will be put through between 2026 and 2027.
Roughly $5 a week. So
Yeah.
we'll get you a coffee unless inflation increases the price of coffees by then.
And complemented by an instant $1,000 tax deduction as well. So there's not sort of a permanent tax deduction. It's really just a one-off.
Yeah. And then biggest losers, I think, from the budget are investors, trust users, and NDIS participants. Property investors were hit by the tax changes that we spoke about earlier, and we'll speak about again in a second. Distributions from discretionary trusts will now have a minimum 30% tax rate.
Yep.
I mean, people might disagree with me. I think that's pretty reasonable.
Well, I mean, if you consider how trusts are used, it is generally by
The wealthiest Australians. Yeah. And then finally, the NDIS. This was already announced by the government. They are tightening eligibility standards and really trying to crack down on, fraud from operators. They expect about 160,000 people to be removed from the NDIS programs. I've seen varying estimates of how much they'll save. The ABC had $15 billion over 4 years. The AFR had $37.8 billion. Either way, it's tens of billions of dollars that they expect to save. This will be the largest single line item saving in the budget. What we didn't see, and what I was hoping they would really come out of left field and do, is actually give us a gas tax.
Gas tax, yeah.
I think just to hold on that NDIS number, let's say, take the AFR's number, $38 billion over 4 years. Pocock's estimate of a gas tax was $17 billion a year. Yeah. So that would have been almost double what the NDIS savings would have given us. So
such a home run.
Important context.
Yeah.
Because as many times as the Treasurer can say this is a bold and ambitious budget, is anything really bold and ambitious if you call it yourself?
So what they said was going to be tackling intergenerational wealth. They've just tinkered around the edges.
Yes.
They had a real opportunity here, and I don't think they really delivered.
Let's get into our thoughts because we've got a bunch. The first one is they recognize that taxes create clear incentive structures, and incentive structures drive behavior in the way that they have approached existing homes versus new homes.
Yeah.
You know, keeping the negative gearing allowance for new homes. But they didn't think about how those incentives also flow between asset classes. They wanted to deal with the spiraling cost of property, which is something that needs to be dealt with.
Yeah.
But the way to do that would have been to make tax on property more onerous than tax on other asset classes
100%.
To create the incentive to push people away from property.
100%.
But instead, we got changes across everything. And I think the one that's probably going to hurt the most is this 30% minimum capital gains.
Yeah, the first part of what you said there, I think they really did have an opportunity to message to Australians, we hear you about property. We're going to take a stand and say that property is not an investable asset class. Imagine if that happened and then they said, all of these tax treatments remain for, well, they still do remain for shares, which is a good thing, but like put shares into this other light.
Well, yeah, shares and new builds.
Yeah.
If you fund a business that grows and employs people, or if you fund a new build, a property that didn't exist that now exists because of your money.
Yeah.
In either of those instances, you have added to the productive capacity of Australia.
Yeah.
You still get a 50% capital gains discount. You don't have a minimum capital gains tax, so you can negatively gear the property.
Yeah.
If you want to just trade apartments in Bondi, that was Paul Keating's famous line in the 80s. The rich people just trading apartments in Bondi. If you just want to buy existing stock, you get slugged.
Yeah.
You can do it, but it's not as attractive.
I know. Missed it. They missed the chance. But yeah, let's touch on the 30% capital gains there, because what it really means is where you're missing out this opportunity to, there's no minimum tax threshold now. $18,200 is the tax-free threshold.
For income.
For income. Yeah, right now. And so, in instances where your partner might be on maternity leave and you sort of sell down some stock to help fund that, or you have a distribution through a trust, we've all relied on this tax-free threshold when it comes to the capital gains. Now, every single dollar of capital gains is a minimum 30%.
Yeah.
It's a real stitch up.
So if you're doing FIRE and you're thinking, I'm going to build, I'm going to work and save and build my assets to a point where I can quit my job, and then I'm going to slowly sell down those assets.
Yeah.
Well, now you can't rely on that tax-free threshold anymore because you're selling assets rather than earning income. And like they did explicitly say they want to redress the imbalance between capital and labor. The question is just, does it go so far to then handicap like really productive uses of capital that benefit us all in, investing in companies and the like.
Yeah.
And I think that leads to the second point, which is they've obviously recognized the impact that it will have on the startup ecosystem in Australia and the willingness of people to fund startups. Chalmers, in the classic case of like dealing with the problem after it's been created, has now said they're going to go consulting.
Yeah, consult with industry.
The early stage
because of the
sector.
blowback. Yeah.
It's like, wasn't the time to do that before the budget?
Yes. He'd be naive to think that there wasn't going to be a pushback, but like we're somewhat in that scene and on Twitter and on LinkedIn and have seen just the enormous pushback from the startup community, business leaders, those that have benefited from building a business here in Australia. The impact of having no capital gains tax puts us at the highest taxable sort of threshold to start a business almost in the world.
Yeah, there's an example that was doing the rounds, published in the AFR. Chris Joy published it across Twitter. If someone started a business with $250,000 and sold it for $5 million, I think 5 or 10 years later, what was the comparative tax rates around the world? And Australia now becomes the worst place to start a business, which is not exactly what we're aiming for when people and capital is so mobile and there's a huge brain drain of Australians already going to the US and there's been some incredible Australian start businesses in the US. We probably want to remain competitive.
You have to improve productivity here in Australia and incentivize growth.
And I mean, to speak to our personal experience, it's hard to raise money as a business. Now, we were two idiots doing a podcast. We probably weren't the best example of real companies raising real money, but God, it is hard. And you don't want to make it harder for these Australian businesses that are trying to get started to actually get started and grow.
It's an absolute J-up.
So yeah, look, I think we're pretty incensed that an effort to deal with property has gone a lot wider than property, and we think there will be negative consequences. But of course we say that. We're share market investors.
Yeah, I think we should say as well, though, that borrowing to invest in stocks, you can, that hasn't changed. You can still use the interest payments against the loan to reduce your own taxable income. So go for it.
Yeah, and again, entrenching inequality in some ways. If you do own a property, you can still pull equity out of that property and invest in shares and then claim all the same tax benefits.
Anyway.
I've got a controversial take.
Okay.
Grandfathering negative gearing was the right thing to do.
Because of rental impact?
Because it hopefully will minimise the incentive for existing landlords to raise rents, to positively gear their property.
I can see that argument.
The Hawke-Keating government removed negative gearing in 1985. It was put on a bit over a year later. There was a big scare campaign at the time, but it was also because rents did rise.
I also just think grandfathering as a concept for me, I think it's fair enough. It's like you can't...
You reckon?
You can't punish someone for a decision that was made in an environment at the time that allowed them to make that decision and then sort of punish them 20 years later and say, sorry, we made a mistake.
The counter argument to that is grandfathering favourable tax treatment is just another example of old people pulling the ladder up from young people.
In this specific example, but I think grandfathering as a concept.
Okay. And then my final observation from the night, it was definitely not called out by the Treasurer. There was a lot of talk about we're doing everything we can to build more homes.
Yeah.
But the budget papers themselves say we're building 35,000 less homes because of some of these policy changes.
He glossed over that one, didn't he?
Yeah. And then their argument was, but it's more than offset by the 65,000 new homes that are being supported by their local infrastructure fund. But what that glosses over is the fact that 65,000...
It was already part of it.
Yeah, you could have not had the 35,000 loss and you could have just had a 65,000 gain.
Yeah. Politics.
Politics. Yeah. Anyway, how do we approach this as investors? For me, nothing changes. Share market investing makes as much sense as it did on Monday.
I agree.
Like you've got like
The only thing that changes is how we account for this.
yeah. I mean, like if you look at the options to build your wealth, saving isn't going to get you to where you want to go. Relying on your salary isn't going to set you up for the life you want to lead. You need to find ways to make your money work as hard as you do. Investing in the share market historically has been a great option, and in our view will continue to be the best option.
Well, with that said, make sure you keep up to date by subscribing to our daily newsletter or our daily Headlines podcast. It's called Headlines. We'll send you a summary of all of the important news from around the world that matter to you and your investing journey. There'll be a link in the show notes or the description below. Coming up, we have our community portfolio. We've got an investment committee to decide on some of the positions in there, and we have another pitch from a community member.
Fire away! Take your best shot and pitch me with your best stock.
There are so many great investment ideas among the Equity Mates community, particularly in our Facebook discussion group, that this year we've decided to try and harness the power, build a portfolio to beat the market by the end of the year, Ren. And so we're going to have a look at how our community portfolio is going, and we've got another pitch from a community member today.
Yes, well, this follows our Monday episode where we were debating some of the positions in the portfolio, and we said we're going to sit down, make some time, and have an investment committee meeting.
Yep.
Which is easy because we are the whole of the investment committee.
Yeah.
So we're going to have that conversation as well. Do you want me to start with just a high level how the portfolio is going?
Yeah, let's do it.
So the good news is we're beating the market.
Great.
And we said what we're comparing ourselves to is like a global ETF, but really we're investing in Australia and the US mainly.
Yeah.
So we chose an ETF that was overweight those two countries.
Yeah.
So we're benchmarking ourselves against DHHF is the ticker. It is up 1.5% so far this year. We are up 5.6% so
how
far
good's
this
that?
year, which is great. But if you keen listeners and watchers would remember, on Monday we were up about 6.5%.
Oh, that's all right.
So it's been a tough week.
If you were very astute at tuning in, you would have realized that we've clawed our way back from underperforming the market.
Yes, we
and
have.
We are on a roll.
Yes. So long may it continue. Some of the top performers: Caterpillar up 28% since we bought it. Alphabet up 24%, Telix up 20%, and some of the losers, Catapult down 3% and Spotify down 15%, which is probably a good segue to our investment committee meeting because it's some of those names that we want to talk about today.
Yeah, I want to start with Catapult.
And you've never loved it?
Yeah,
Fair to
that's
say?
true. That's fair to say. That's fair to say. I mean, look, some of the underlying numbers of the business are going in the right direction. Revenue's growing. They haven't been profitable on a full year or half year basis, but I think they have...
They've got adjusted EBITDA.
EBITDA.
But they call it management EBITDA.
Exactly. They have just had their first period of positive cash flow.
They've been cash flow positive for a little while.
Okay. Yeah. So look,
well, in and out.
In and out, yeah. The stock has been going sideways for a little bit now, and given that we are trying to beat the market by the end of the year, I think we need a few more earnings cycles for the market to turn around and start changing the momentum for this stock. So in light of how we think about our portfolios and there always being a potential better opportunity than what is currently in your portfolio, I'd like to bring it to the table that perhaps we redeploy that position elsewhere.
Yeah, okay. So to give people some context, between October 2025 and February of this year, it dropped about 50%. It halved. From February to now, it's been flat, basically. So maybe it's leveled out and some good news would push it up again. Or maybe it's just going to trade sideways or have another leg down. We don't really know. But you're right, there's not a lot of momentum in this name. Now, if you want to hear a more robust debate on Catapult, we should say on the most recent episode of Buy or Sell that Ali Selby is hosting, the two expert fund managers did debate this stock. One thought it was a buy, one thought it was a sell.
Great.
So that was an interesting one to listen to. I still believe in this story and this stock.
Yeah, same. But it's a 2 or 3 year story.
I'm happy. Well, no, it could be a 10-year story.
Has to be.
Yeah. It reminds me a little bit of the setup with Axon, which was a taser company, and then they went into software as a service with their evidence.com platform and body cameras. A lot of people kind of ridiculed them at the time. People didn't think it was a great move, but now that's been a wonderful move for them. And you could sort of see Catapult is like trying to get into SaaS, trying to get into more analytics, and move from just selling the equipment to selling more of an ongoing subscription model. The fact that they're so entrenched in these teams, you could see an argument that this becomes like a really nice growth driver of their business, and a much more profitable growth driver of their business than selling trackers and the sports bras. But, we'll have to wait for that story to play out to see if teams do want to pay more to use their analytics software, and they've made some acquisitions and they're talking about AI, and it's like, that is a story that is just developing.
Absolutely.
So look, long and the short of it is, you probably have more conviction here to sell than I do. I'm neutral.
For the short term.
And backing you has held me in good stead in life. Look at where we are. So I'm going to back you on this one.
Okay, well, fingers crossed. Well, not fingers crossed, but yeah, I think...
Here's the question.
We'll keep watching it.
We've just freed up about $1,000.
Yeah.
Do we then get to invest that?
Absolutely.
Okay, yeah, cool.
Yeah.
All right.
Yeah.
Now I'm with you. All right, well, what do we want to deploy this into?
Well, the whole idea here is to try and bring ideas that we've spoken about on the show and that, might have come from experts or what we've been recently looking at. And one that comes to mind is Berkshire.
Oh, interesting. Okay.
That's because we've just come off looking at the results for some of the companies in our portfolio. Alphabet, we looked at. TSMC was in yours. Eli. There's a lot of great stocks out there.
Yeah.
But something that we spoke about was Berkshire sort of being like the anti-AI play.
Yes. I don't know if we've actually spoken about this on the podcast. I think we've just spoken about it.
Yeah. We did at Berkshire earnings.
Oh, did we? Oh,
yeah,
okay.
we definitely have.
Cool.
Yeah, we do a lot of content.
It all blends together.
So the reason that I'm tabling this for the investment committee is because we've got a lot of stocks in there that, if the AI bubble bursts, will likely be impacted.
Yes.
Got Alphabet, we've got Drive, we've got the AI infrastructure. There are a number of in there. Whilst Berkshire doesn't have, this huge momentum behind it, in fact, I probably think it's flat or slightly down for the year, it's just a sort of solid, safe bet because it doesn't have a lot of exposure to the AI thematic. It will get dragged with the market. It's one of the world's largest companies, but I'd feel safer putting it in there than I would going down the route of another big tech or AI.
No, I see that logic. Yeah, so it's down about 7% in the past year, but it's trading sideways. If the AI bubble bursts and the market meaningfully falls, it will be one of the biggest beneficiaries because it may give it a chance to deploy the $400 billion of cash that it has sitting on its balance sheet, and it could really set itself up for the next stage of growth. I see that logic completely, but it does contradict your short-term momentum play. So let me put another one to you.
The counter just to that would be that if the market falls for an AI play, it won't fall as much.
Yeah. I get it. So one of my biggest holdings is Taiwan Semiconductor, and it's not in our portfolio, and it feels like it's an oversight.
Yeah.
I spoke about it recently on the show in our monthly portfolio update, so I won't labor the point, but it's more than doubled in the past year. It's the leader in the semiconductor space. It is mission critical to all of this AI stuff, but also to other technology fields. More than a quarter of their revenue now comes from chips for cars, and that's only going to continue with EVs and self-driving cars and the like. If the AI bubble bursts, obviously demand will fall. Obviously profit margins will fall. By the way, profit margins above 50% in the most recent report. Yeah. But it's not like a pure AI play in the way that, like an Iron Energy would be or something. So for me, it's like, if we want to try and beat the market in a year and we want a high quality company to do it, this is where I'm going in my personal portfolio.
Well, the momentum's there. It's up 41% year to date.
I recognize that if the bubble bursts, if this is a bubble and it bursts, we'll be in trouble with this company. The index will also be in trouble.
It will be.
So,
Yeah.
look, why don't we say two great companies? I'd be happy to put either in there. Let's put it to a vote.
Okay.
There's plenty of places you can vote these days. So why don't we say this? We'll do a vote on Instagram stories, on YouTube, and on Facebook discussion group.
Yeah, nice.
And it will be each vote will
We'll just
be
be the
one.
most votes.
Yeah, no. So it's like if you win Facebook and Instagram, and I win YouTube, then you win 2-1.
Okay.
Yeah.
Okay, nice. Look, I don't think either
We've
option...
made this unnecessarily complicated.
I'm happy with both, to be honest. So it'll be interesting to see what the extended investment committee think.
Yeah, all right. Well, with that said, we do have another pitch for the portfolio. This is our first non-equities pitch, non-stock pitch. But we said the rules at the start of the year, we actually went back and checked. As long as it was easy to buy for investors like us, it could be added to the portfolio.
Yes.
So with that tease, let's get to Reece.
Well, Reece, welcome to Equity Mates.
Hey, thanks for having me.
Very exciting to have you in the studio. Now, before we jump into your pitch, can you give us a bit of an introduction to yourself?
Yeah, so my name's Reece. I'm 22. I'm from the Central Coast. I live in Woy Woy, and I'm an apprentice carpenter. So I've been investing maybe, call it about 3 years, not very well, but listening to you guys have made me a bit better.
Yeah. Are you stocks or ETFs?
I'm pretty much all ETFs with like a touch bit of crypto. I'm keeping it pretty safe for now until I know a bit more.
You're 22 and you've been investing for 3 years. You're killing it.
Thank you.
Yeah, keep it up. Like, that's great. What are you bringing to the community portfolio today?
Yeah, well, it may not mimic my very safe portfolio. I'm here to pitch Bitcoin.
Okay.
It was only a matter of time until someone brought Bitcoin.
Yeah, we must have allowed Bitcoin to be pitched because we haven't set any rules, I don't think, around asset classes.
Our producer Phoebe had a look back at what we said, and we said as long as something is easily investable by Australian retail investors, we can invest in it. And I think Bitcoin's pretty easy to invest in.
Definitely.
Well, just in case that like Bitcoin, technically it's a currency, I can't pitch it. I did come with an alternative Bitcoin ETF.
Yeah, there you go.
I guess would count.
Good.
Yeah.
That is the loophole. All right.
good.
Well, we kind of know what Bitcoin is.
Yes.
What is the reason that you're pitching it?
So it's had a massive hit just before the war, I think. We were in a bit of a crypto bear market.
Yeah.
I'm not really betting on a massive growth cycle. I'm just betting for a recovery. And if it recovers back to where it was before, it'll be beating the market, which is, I guess, the principle of this segment, right?
It is the principle of this segment.
It's had a good run recently. What? Just in the last month, I'm just getting it up here. It's almost up 20% in the past month.
Yeah, right.
Yeah.
Oh, man, it sucks because when I put it in, it was about 72K Australian, we're keen. But yeah, I think to really write home those ETF inflows before that massive bear market start, we had a lot of upside with that. I think it was 88 billion of cumulative compound ETF inflows since inception, which was just crazy.
Yeah.
In the world of trillion-dollar market caps, it might not sound too much, but for a currency like Bitcoin, I think that's a massive amount of inflow. So yeah, I'd love to sit here and say there's going to be massive adoption, but I think just the money flowing in from institutions would be enough to get you over the line.
Yeah.
Okay. So, yeah, its most recent peak was 6th of October, 2025. It fell roughly 30% to mid-November, went sideways. And then, as you said, at the start of the year, actually before the war, from the 17th of Jan to just early Feb, fell another 30% and has gone sideways from there. The momentum is back.
Momentum is back.
And it's
Get
hard
excited.
to stop.
And I mean, look, this community portfolio is a 1 year deal. We're trying to beat the market this year.
Yeah.
So momentum is what we're chasing. But we do have to ask, what are the risks? And, particularly with Bitcoin, we know how volatile it is. But what would you be watching, and what would you say if we do put it in the portfolio? When would you say, you guys should cut it?
Oh, look, it's a good question. There is I've heard the argument that AI is going to crack the encryption.
Yeah.
Any sort of risk of that, if that's imminent, maybe get her out. But look, in terms of...
I don't think they'll give us warning that they've cracked it.
I don't actually know what a warning sign would be. That would be on the cards. So what would you guys think?
Well, I think holistically, if we separate this from the game and you think about crypto in your portfolio, your risk management is position sizing. Like the volatility of Bitcoin, as we've just pointed out, has fallen 50% in the space of a few months. Ultimately, it's speculation more than anything because this is not an asset class that generates cash flow or anything like that. So there will be Bitcoin believers that disagree, but like at the end of the day, the way you manage risk with cryptocurrency is how much you allocate to it in the total portion of your portfolio.
How much of a percentage is crypto in your portfolio?
Oh, look, call it not even 10%, I don't think.
Okay,
like, it's fairly low.
Yeah.
Enough for me to, get my heart rate up a little bit. Start looking at the news.
Enough for you to feel the win when it starts rising again.
Yes, for sure.
Now, there are multiple ways that you can get access to Bitcoin. You can buy it directly through crypto exchanges or you can do ETFs. How do you buy it?
Yeah, personally, I have a crypto account through Coinbase, but I think IBIT, is that right? The ETF for BlackRock.
Okay.
I think it's...
IBTC, is it?
Something like that.
There is IBIT and there is IBTC.
Yeah. I'm pretty easy. I think pretty easy. I think we put it in. I think we let it ride. The momentum's there.
It ticks the market cap box.
Yeah, it definitely does. For me, I would be saying we're probably going to ride this with a pretty tight stop loss. If it starts falling, we might cut it. But I think whether we do the ETF or whether we do actual Bitcoin, it's 6 of one, half a dozen of the other for me.
Share site supports all of it, so that's good. I love a momentum play.
Yeah.
Given we're trying to beat the market by the end of 2026, this is also a yes. Personally, I hold crypto as well, so I want to get it in.
Yeah, we'll love it, Reece. Thanks for pitching it.
Awesome.
Our first cryptocurrency, our first non-equity in the portportfolio. So
if you think we should sell it, though, give us a call.
I will. I'm that guy.
Yeah. And keep investing, man. Like investing for 3 years at 22. Keep it up. Love to hear it.
Love it.
Yeah.
Thank you guys so much.
Thanks, Reece.
Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce and Ren. I've got a question.
Answered.
We love getting questions from the Equity Mates community. So many coming through. Today's question, Ren, comes from Jack.
That's right. It came from our contact form, equitymates.com/contact. No voice note, but Jack has asked for a one-on-one. Not a one-on-one.
He wants to come in and have a one-on-one.
A 101 on gearing and how to use it.
A 101 on gearing. Well, if Jack wants to come in and have a one-on-one as well, we would consider it. All right. Well, great question. We actually have so many questions come through on leverage, on gearing. Yes. We did one recently with Matt Ingram in our Ask an Advisor episode. So we're going to go through it, what it is, the key distinctions to watch out for, some of the products that you can look for. But then we've got some research at the end to also show the appropriate level of gearing for long-term portfolios, because that's really where this debate usually ends up, which is, people sort of think over the long term, it's not good, you get slippage and the like. So we'll get into that.
It's the classic, where do you find the balance between risk and reward?
Yeah.
So let's start. What is gearing for people who are unfamiliar with the term? Gearing and leverage, two words that really describe the same thing here. Borrowing money and using that money to invest.
Yeah.
So hypothetically, I have $10,000 to invest in the market, and if I just invest that, I've got $10,000 of exposure. But if I borrow another $5,000, then I all of a sudden have $15,000 of exposure. I get 1.5 times the gains if the market goes up. I get 1.5 times the losses as the market goes down. I probably pay a little bit of interest along the way as well to whoever I borrowed the money from. Strip all of the jargon away and all of the different ways to do it. Fundamentally, that's how it is.
Pretty easy.
Yeah.
And the most common form of gearing for most Australians is a mortgage.
It's a mortgage. We love gearing.
Yeah.
Now, particularly in America, although it is coming more in Australia, there are like derivatives, CFDs, options, ways that you can make like leveraged bets on certain things. Not what we're talking about here today. High risk, often low reward. I think the numbers are like 87% of retail investors lose money trading CFDs. So lose more than they invest trading CFDs.
Well, they're so dangerous that I think on the websites of CFD providers, they have to put that stat.
Yeah, they do. Yeah. So when you're talking about being a sensible long-term investor, forget all that. This is the conversation to have, because there are ways to incorporate some level of gearing that we think are can be appropriate for long-term sensible investors.
Yeah.
The property thing is the thing that we always come back to. Like the reason that property has been such a great wealth builder isn't because it's had like incredible rates of growth. It's grown less than the stock market over the long term.
Yeah.
It's because of the leverage.
Well, yeah, it's because you put in $20,000 and you're able to buy a $600,000 asset.
Yeah.
And you do that for 30 years.
Yeah.
Makes sense.
Yeah. Exactly. Or these days you put in $50,000 and the government will let you buy $1 million
Yeah,
asset.
exactly. And you don't look at the price. You keep plugging away and paying it off over 30 years, and ultimately it goes up over a very long time.
Yeah, and so we're not here advocating for 95% LVR ratios for our share portfolios, but we're saying you can appropriately incorporate some leverage, and that's the research that we're going to talk about at the end. But before we get to that, we need to explain the different ways you can do it.
There's sort of two ways that you can look at leverage, and that is expressed through a number of the products that we're about to talk about. Internal gearing and external gearing, you need to understand. So internal gearing is where the fund manager or the product issuer, they themselves go out and manage the borrowing. So you buy units in the ETF or the fund, and the fund manager then goes and borrows money to increase the exposure of the underlying assets in that fund. You don't have to do anything. They manage the interest costs, they manage the LVR. It's all internally geared. You just buy asset, you just buy the unit.
And generally the cost for you there comes in the management fee being higher.
Yes. The second is external, and that is where you take on the debt yourself. The debt is yours, and this can come through borrowing directly from a bank. There are a number of ways that you can do it, but everything that comes with borrowing money, you have to absorb. Interest repayments, debt, interest costs, tax, you name it, you have to manage it, as well as managing the risk.
The classic example of external gearing is your house. You go to the bank and arrange financing, and then you can choose what house you buy. And the reason that a lot of people choose externally geared options with shares is you have more flexibility.
Yeah.
Not complete flexibility though, and we'll get to that. So let's start with the externally geared options. The most popular, although we would say maybe not the best, is a margin loan.
Yeah, so a margin loan, this is the most traditional way of getting exposure or getting gearing for stocks. And this is where you go out and you borrow money against the value of your share portfolio. And so the lender will say that you have to have a particular loan to value ratio against generally an approved list of shares and ETFs. And then it's on you to ensure that that LVR stays within the band.
And so to put that into a worked example, let's say I had my $10,000. The bank says you can have an LVR of 50%. So I can borrow another $10,000. 50% of the money's mine, 50% of the money's theirs. But if the share market falls, all of a sudden, the value of my collateral, my shares, has fallen, and maybe I haven't put any of the bank's money to work yet. All of a sudden, I'm no longer at 50%. The bank calls me up and says, you've got to put more cash or more shares or more whatever of value into your account to get it back to 50%. And so often those margin calls come at the worst times because the market has fallen.
Yes. The margin loan, in our view, it comes with often much higher interest rates and a lot of stress as well.
The structure of the product isn't conducive to long-term investing, riding out volatility in markets.
Which is where the next product comes into play. It's the NAB Equity Builder, something that both you and I have used, Ren, over the years. This is much closer to a mortgage style setup. It's where you can take out a loan over, I think it's 3, 5, or 7 years, and then that loan is just a principal and interest repayment. Regardless of what the underlying assets do, it is a principal and interest repayment. So you're not going to get the margin call from the bank. The downside are, again, much higher interest rate repayments, and also a very limited investment menu, because obviously NAB is saying we don't want you going out there and buying speccers. You've got to buy sort of much more safer, I would say,
it's
lower volatility.
ETFs and managed funds.
Yeah.
You're not really buying individual stocks.
No.
It's still, like, for us, was a good way to get a bit of a head start.
Yeah.
The challenge is the interest rate is a lot higher than when we
did it when interest rates were zero.
Yeah, and we were
the rate
paying
on
what,
it was,
like,
I think, 2.5 to 3%. It slowly moved up to sort of 4.5, 5. It's now in the 8s.
It's 8, yeah. And so if you think about your expected return, obviously there's a tax benefit because you can claim the tax deduction on that interest, but put that tax benefit to one side. If your long-term expected return is, call it 8%, and you're paying 8% in interest, the math doesn't really work.
No.
What we would love to see, no one does this, is an interest-only style
I love
product.
that.
Yeah.
Love that. Then closing out external gearing, you can use equity in your home to invest. So again, we've both done this. You can draw out the equity in your home and use that to invest. And then you can also do a personal investment loan, which comes with, again, much higher interest rates.
So none of them are perfect, but they're all options that people can consider. Then we turn to internally geared products. The range of these products has really expanded in Australia recently. The other thing is most of our brokerage accounts give us access to America.
Yeah.
And unsurprisingly, everything in the US market is at an absolute extreme.
Yeah.
And the extreme range of products in America is pretty wild. So we'll close out there. But let's start with, I guess, the more moderate versions in Australia.
So the first is moderately geared products. This is where you're getting exposure of around 1.5 times.
Yeah. So if you put $10,000 in, they put $5,000 in for you.
Yeah. Rough. The ranges do vary, but like generally speaking, that's what you're going to get. Betashares have a wealth builder range. DHHF is their first, and G200.
Sorry,
GHHF.
Yeah. DHHF turns into GHHF, A200 turns into G200, NDQ turns into GNDQ. And so they're, I guess, a more moderate level of gearing. Then we get to the, I guess, 2 to 3 times levered. So these are ones where if you put $1 in, the fund manager will put $1 or sometimes $2 in for you.
Yep.
Now, a couple of fund managers have them in Australia. Global X have ultra long. They also have ultra short ETFs. Betashares have 2 quite popular ones, Gear and GGUS, that follow the Aussie and US market respectively. What you also see in this range are some active managers coming to play. Now, I couldn't quite find their level of gearing, and that's actually a call out that they should be more explicit about what their gearing level is on their website or on their fund fact page. But First Sentier have a geared Australian share fund. So now there are some active managers who are giving you gearing as well.
Nice.
And that's by no means a comprehensive list, but that's just to give you a taste of the options out there. There's sort of passive, active, there's long, there's short.
Yeah.
If you want gearing, you can find it.
If you then look at what you can get exposure to over in the US, it gets a little bit out of control. So this is where you can get beyond 3 times gearing. There is a 4 times leverage S&P 500 listed in the US.
Yes.
You can also find 3 times leveraged single stock ETFs. I'm pretty sure there's a leveraged Tesla, there's even a leveraged Bitcoin ETF. It gets a bit ridiculous. It gets very dangerous because, as we've said, whilst you can get 400% exposure on one side, it goes down the other way as well.
Exactly. And if you want it to go the other way, there's also 3 times leveraged short single stock ETFs over there. And it's not just the big ones. It's not just like Tesla and Nvidia. There's the range of ETFs is
it's
stupid.
Ridiculous.
Yeah. So I guess let's close this out. That's the 101 on how you can access gearing externally, internally, some of the different options. Let's talk about what we choose, and we both choose internally geared products and we err towards moderately geared products. And the reason is this concept of the efficient frontier.
So we've come across some interesting research that shows against the major indexes around the world, S&P 500, Nasdaq, global index, and the ASX 200, where the risk of gearing versus long-term returns starts to deteriorate, and what level of gearing that is. So what it really says is that at about 1.5 times gearing across all the markets, that's like the optimal point for gearing where you get maximum return over a long period of time.
Yeah, and the reason that smaller levels of gearing, your returns start to be amplified is intuitive. It's because you're borrowing money to invest. Markets generally trend up over the long term. and so your returns are enhanced. But at some point, the impact of volatility and of when the ETF falls, then having to then reset the level of gearing and the losses that you make from that start to actually erode your returns. It starts to become less efficient, I guess, to have more and more gearing in your portfolio.
Yeah.
So in this example, it looked at those 4 markets from 2001 to 2025. So a pretty meaningful sample size. It had, the 2001 tech wreck, the GFC, the COVID crash, like some meaningful market falls in that time. And yeah, you're right. As you said, across all those 4 markets, the efficient frontier sat around that 1.5 times gearing.
Yeah.
And so we as long-term investors want to enhance our returns. We don't want to detract from our returns. And so that's why we choose to sit around that level.
Just looking at the research coming off speaking about 4 times leverage as well, it's interesting to see. It's not surprising to see that at that level of leverage, your benefit falls off a cliff.
Yeah.
So don't do it.
Yes, don't do it. No one go and buy the 4 times leverage ETF in the US. If that's the message from this episode, then that's time
Moderate
well
gearing.
spent.
Moderate gearing works over the long term.
Yeah. No one should go and do Australian property levels of gearing on their share portfolio.
No.
All right, well, Jack, hopefully that answered your question. Bryce's offer for a one-on-one stands if you want to hit him up. But you don't need gearing in your portfolio. You can build, huge amounts of wealth, just having your money tick away in indexes and in shares that you like. But if you want to add it, it is a tool that is available for investors. So hopefully that helped you understand it.
Love it. Well, thank you for the question. Keep them coming, equitymates.com/contact. But Ren, we'll leave it there and pick it up next episode.
Sounds good.
You've been listening to an Equity Mates media production. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. If you're unsure, please speak to a financial professional. The host of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under Australian Financial Services Licence 540697.